Good morning. Right. So the other day we have discussed the three statement financial modeling, right? So in this case, let's try to understand the other financial models, right? We'll start with the first case, that is comparable company analysis. So kindly open this file, comparable company analysis, right? So let's try to understand what is this comparable company analysis. Then we'll try to calculate the value of the company as per the comparable company analysis. Comparable company analysis is one of the valuation model in which we are going to find out the value of the company based on what is called as the similar companies. So let's company, we are trying to find out the value of Ranbaxy Company Limited, Ranbaxy Pharmacy Limited. Then what we do? We identify its competitors like the Cipla or what is called as the other pharmaceutical companies which are into producing the pharmaceutical product, right? Then we find out value for such competitors, that is for such similar companies. Then based on that value, we are going to fix the value for the Ranbaxy Limited. There are many parameters on which we are going to find out the value of the company, such as the revenue parameter, EBITDA parameter, net income, and so on, right? So let's see how to calculate this, and then on the basis of which we find out the value of this company. So let's find out the value of ABC company here, right? That's a target company. The similar companies are identified as XYZ, PQR, KLM, BCT, and then MNO, right? Now, first we'll find out the equity value, that is the market value of equity. So, what is the input required? What are the inputs required for market value of equity? We require the number of shares outstanding and also the shares outstanding, right? And also the share selling price per share. So, the market price per share multiplied by shares outstanding will give us the market value of equity. How do you find out this now? So, we have the shares outstanding here multiplied by the market price per share, that is the D77 multiplied by E7 cell. Enter. So we calculated the market value of equity for ABC company. In the same line, let's find out the value of the other similar companies. How do you find out? Since we already fixed the cells here, we have put the equation by using the reference cells. So let us drag this towards the bottom. We get the values automatically. The value of market value of equity for the remaining companies we have calculated. Now, how do you fix the enterprise value? Enterprise value is basically the company's value, which is the total of debt and equity, right? So let's say how to find out the value of equity and the value of debt here. So we have the value of equity, put it in reference cell F7 plus the value of debt is in G7. Let's take a total of this two, F7 plus G7. That will give us the enterprise value here. That will give us the enterprise value. So which is basically F7 plus E7. That's a enterprise value 2170. Let's drag it towards the bottom. So we get the enterprise value for the remaining similar companies. Now, based on this, we'll find out the value of each parameter, that is revenue, EBITDA, and then net income, right? How do you fix? All the formulas are recorded here for your understanding. EV divided by revenue will give us the revenue parameter, EV by EBITDA, EBITDA parameter, P ratio, price to earning ratio. How do you find out this now? Let's use this equation is equal to the enterprise value we have just now calculated, which is in H7, right? Divide this with the revenue. The revenue is in J7 cell. H7 divided by J7 will give us EV divided by revenue. So which is nothing but 2.6x. That is 2.6 times. What does it mean? 2 point times of revenue is the enterprise value as far as ABC is concerned. So what does it mean? 2.5% of the revenue is the enterprise value for ABC Limited, right? The next case, XYZ, 2.8 times of the revenue, 2.8x stand for 2.8 times of the revenue is the value of the company as far as XYZ company is concerned, right? In the same line, let's find out EV divided by EBITDA. How do you find out EV divided by EBITDA? That is enterprise value, which is in S7, Divide this with the EBITDA value, which is K7. H7 divided by K7, that will give us the EV divided by EBITDA value. So let's drag it towards the bottom. That is 7.1x, 8.5x, and then 6.0x, and then 7.9x, and then 7.8x, and so on. Right? We have calculated revenue and then EBITDA. Let's find out the P ratio now. The P ratio stands for price to earning ratio. P ratio stands for price to earning ratio. How do you find out price to earning ratio? Usually MPS divided by EPS. We have market MPS information directly given here. That is the market price per share, the value which are given in the very first column. But we do not have the EPS value here. So what we can do, we can put it in the other way. MPS divided by EPS is as good as the market value of equity divided by net income. Right? So the market value of net equity, if you divide with net income, that will be as good as the MPS divided by EPS value. So how do you put market value of equity divided by net income here? Let's use the reference cell is equal to the market value of equity we have in reference cell F7. Let's divide this with net income, which is L7. F7 divided by L7. So 10.6x. 10.6x. So what do you mean by that? 10.6 times of earnings is the market price per share. 10.6 times of the earnings is the market price per share, or 10.6 times of the earnings is contributing to the value of equity. That's the meaning. So let's find out for the remaining companies. What we have done, we have just dragged the cells here. Okay. So we are trying to find out the ABC valuation now. We have found all the similar company values here, right? Now what we're supposed to do, we're supposed to consider the either the maximum value and optimistic situation. Let's say everything goes in favor of the company, that's ABC company. Then the company can achieve maximum value of the revenue, EBITDA, and then price earning ratio. So we can consider here 3.0, and then we have 8.5, and then we have 11.6. This is the maximum value here. So we can consider that maximum value, and then we can fix up the value for ABC Limited. Or under pessimistic condition, let's say nothing is in favor of the company under the adverse condition, the minimum value can be considered for fixing up the value, like 1.1 we have here, then we have 3.9 here, and then we have 4.6 here. These are the minimum values, right? So we can consider minimum value, and then we can try to fix up the value for ABC Limited. But it's not that always we go for optimistic situation or the pessimistic situation. What we do here, for a situation like most likely, like the average of either optimistic or pessimistic, in such a cases, what value should we consider? So what we're supposed to consider, we're supposed to consider the average value, or what is called as a median value. Let's see, when do we consider the average value and when do we consider the median value, right? So we'll try to find out the value here first. First, we'll find out the maximum value. The equation for maximum equals to max, open the bracket, open the bracket. Let's select the reference cells. These are the reference cells, N7 to N12. Close the bracket, enter. So we calculated maximum value for the first company, sorry, for all the common cases, 3.0x, and then we have 8.5x, and then we have 11.6x. Same line, let's find out what is called as the quartile number, deviation number 3, right? How do you find out quartile deviation number 3? So let's put this equation, just a second. Yeah. So let's try to fix the value of quartile deviation 1, quartile deviation 3, and so on, right? So how do you find out the quartile deviation 1? This is the equation equals to quartile, open the parenthesis, open the parenthesis. Let's select the array that is the reference cell N7 to N12, come on. This quartile division 3, right? 3 stands for 75th quartile division at 75th term, right? So what we do here, we'll just fix up this value. 3 stands for 75th term. Close the parenthesis, enter. So if you arrange this data in a chronological order, the value of Q3, right? The value of Q3 is 2.766. Let's drag it to the other side. So we have got the quartile division 3. Let's find out the average now. Equals to, how do you find out the average? This equation is equal to average. Open the bracket. Select the range. Close the parenthesis. Enter. Drag it to the remaining cell. We have calculated average value. Let's find out the median value. So how do you fix up the median value here? Equals to median. Open the bracket. That's the midterm. It's 50th term. Select the reference cell. Close the bracket. Enter. 2.4x. So let's drag it to the right hand side. Then we'll find out the value of quartile deviation 1. That is 25th term here. So how do you find out the 25th term? We'll use the same equation, equals to quartile. Open the parenthesis. Select the data array. N7 to N12. So 25th term stands for quartile deviation 1. So let's use the number here. Number 1 stands for 25th term. Close the bracket. Enter. So we also have got 25th term for all the 3 cases. The last one is low value. How do you find the low value? That's a minimum value. We use this equation equals to MIN. MIN stands for minimum. Open the bracket. Select the data. Come on. Close the bracket. Enter. So the minimum values we have got here. Now what we have done, we have calculated some statistics for this data. Why do we require this information? So as I told you, depending on the business condition, we are going to consider either the maximum value or the minimum value or the most likely value. Let's try understanding. So when do we consider the average value? When do we consider the median value? When do we consider the average value? When do we consider the median value? Yeah. So let's make a note of this equation now. We'll find out the entire enterprise value based on the revenue and then EBITDA and then PE case. And then we'll try to work out here. So let's put for implied enterprise value. So all of you please look at this now. Is equal to, so let's consider the average. We presume that the data is normally distributed. When the data is normally distributed, we go for the reporting the average value. If the data is not normally distributed, if the data is distribution free, then we're supposed to report what is called as a median value right now. So let's talk about the data is normally distributed here is equal to, open the parenthesis, open the parenthesis. How do you fix up this? The average Revenue parameter is 2.366. That's the average value. Just a second. Equals to the average revenue is 2.366. Okay, it says that 2.36 times of the revenue is considered the value of the company, value of the firm, right? So we have the revenue 2.366 that is mentioned in N6 reference cell. This we multiply with what is the revenue of ABC Limited? We are trying to find out the ABC valuation. What is the revenue of the ABC? It's 845, correct na? Which is in reference cell J17. N16 multiplied by J17. And then press enter. So now we have got the EV2 revenue value. That is the value of the company as per the revenue parameter is 1,963. Now let's try to find out the net debt value. We have the net debt value of ABC mentioned here in reference cell G7. So we'll simply straight away put this equation is equal to G7 enter. Now find out the implied market value. Implied market value is nothing but implied market value of the equity, right? How do you find out the value of market value of equity? Already we have put the equation. If enterprise value is the total of equity and debt, then the equity value is the difference between enterprise value and the net debt. So let's put this equation is equal to N92, N22 minus, so the debt value enter. We get the implied market value 1,223. And then we have the shares outstanding listed here. Where do we have the shares outstanding? Here in E7 reference cell. So let's use this equation. Implied value per share is equal to N24. Divide this with number of shares outstanding. That will give us implied share value of share per share. Same line. Let's try to find out the value of EV to EBITDA, enterprise value to EBITDA. So let's use this case now. Is equal to, again the same approach. The average EBITDA to earnings enterprise value is in O16, 6.9 times of EBITDA. So EBITDA is listed in K7 reference cell. O16 multiplied by K7. Close the bracket, enter. Then we have the net debt value, which remains same, 740. And then we can find out the enterprise value of equity. Market value minus debt is equal to enterprise value of equity. Number of shares outstanding remains the same. 1355 divided by 125, 10.84. Okay. Now, we have calculated the value of the firm and also the implied value per share as per revenue and then EBITDA approach. But the next one is PE ratio. So here you should be, we should be very careful in understanding the enterprise value. The workings will be quite dissimilar here, right? It's not different, same as what we have done in the previous two cases. That's revenue and EBITDA. How do you fix up the value here? So first we'll start with the market value. How do you fix up the market value? The average PE ratio is 8.9, which is in reference cell P16 times. So what does it says? 10.0 times of net income is a market value of equity. Correct. Now, or here you should take the first value. 10.6 times of the earnings is the market value of the equity. In the same line here, we put the same equation is equal to the average is 8.9 times of what net income or the earnings, which is in L7. P16 multiplied by L17. 1198. The debt value remains the same, 740. So let's take a total of this two, that is market value of equity plus the market value of debt. The workings will be in a reverse approach here. Right. Now, how about the number of shares outstanding? It remains same, 125. Find out the value per share, P24 divided by 125, which is equal to 9.58. Yeah. Now we have done the value of the company based on comparable company analysis. It's also called as relative valuation model, right? So what do we draw out of these numbers? If you go by the revenue, the value of the share is per share is 9.79. EBITDA will give us the maximum value per share, which is basically 10.84. PE will give us 9.58. What we have done now, we have calculated value of the company based on the data what we had by presuming that the data is normally distributed. If the same data we presume that distribution free, instead of considering the average value, then we can consider the median value, right? So since the value is maximum as per the EBITDA, so we can find out the value of this ABC company based on EBITDA approach. That is earnings before interest, tax, depreciation, and amortization, right? Okay. So this is what is called as the comparable company analysis. So this we call it as comparable company analysis, right? So let's save this file. Okay. So having understood the comparable company analysis, let's go to the next one, sum of parts method. So what do we do here? We'll take up the next discussion, the next model, sum of parts method. Yeah. So let's try to understand the valuation of the company based on sum of parts method. Right. So what do we do in case of sum of parts method? First, we find out the similar business operations. For a business operations which are doing, which has many branches, for all such cases, we fix up the enterprise value. Okay, one example is given here. Let's consider software business. That's basically a programming software business. We have division 1, division 2, division 3, right? So these are the similar business operations divisions, correct? Now, with the help of this, we'll try to find out the value of software business, that is a programming software business for division 4, right? So that is what is called a single business sum of parts method, where we'll be comparing the value of the company of similar divisions which are into same business operations, right? Then coming to the second case, multiple business operations. Here we find out the value of the company based on the what is called as multiple business operations. A software company may into different business operations such as programming services, coding services, open source softwares, and then so on. Correct. Now, what we do here, we'll fix up the value for enterprise value for all such business operations, and then we take a total it. That will give us the enterprise value. Right? Let's try to understand this now one by one. Start with the single business operations. So we already have calculated enterprise value, which is basically debt and equity total 120 million, 70, and then 120 billion. So the earnings is given, that's a net income, which is 20 million, 10 million, and then 15 million. So we'll fix up this case now. Enterprise value divided by earnings is a number of times earnings contributing to the enterprise value, right? So how do you find out this now? We'll say this C5, that is enterprise value is in reference cell C5. Divide this with the earnings value, which is D5, C5 divided by D5 enter. So the enterprise value to earnings value is 6 times, right? Let's drag this towards the right hand side. Let's drag this towards the right hand side. We got enterprise value to earnings. Now what we're supposed to do, we cannot consider the maximum value, we cannot consider the minimum value. So minimum value is for a pessimistic situation, maximum value is for optimistic situation. What we do here, we take up the average value, the most likely case. How do you find out the average value? Let's put this equation equals to average, open the parenthesis, select all this reference cell E5 to E7, E5 to E7, close the parenthesis, enter. The average value is 7. That is 6 plus 7 plus 8 divided by 3 is equal to 7. Right. Now, okay, since already we placed a value here. Now, what we do here, based on this average value, we fix up the value for the fourth software business division. How do you fix up the value here? So, EV to earnings is a 7 times. So, let's say equals to 7. Now, how do you find out the enterprise value here? That is 7 times of the earnings is the enterprise value. So we take this approach now. 7 multiplied by 15, that is 11 multiplied by 11. That would be the enterprise value. So the enterprise value in this case is 105 million. That's a fourth division. That is a fourth software business division, the enterprise value. Right? So this is called as the single business sum of parts method. So what do we call it as? Single business sum of parts method. The same line, let's find out the multiple business sum of parts method. Let's come to sheet number 2. Let's come to sheet number 2. Okay. Here, what do we do? We find out the enterprise value for different business operations, and then we take a total of it. That would be the enterprise value. For we have programming services, then coding services, open source softwares, and then head office. Based on that, we fix a value for enterprise value. How do we do that? Let's do this case now. So the programming services enterprise value. We already calculated the enterprise value to earnings for the programming services. So all of you, let's come back to the previous sheet. Yeah. So let's find out the average value now. Okay. How do you find out the average value? So here, let's use this equation. The EV to earnings of the first division is in E5 plus second division E6, third division E7. Just now we computed the EV to earnings of the fourth division also, which is basically in the reference cell E11. Correct now? So this, what do we do? We divide this with average, that is basically 4 divisions. So it is E5 plus E6 plus E7 plus E11. Divide this with 4. So what is the average value here? The average value is 7, right? Earnings to enterprise value is 7 times. So let's come back to the multiple business sum of parts method. EV to earnings is 7 times. EV to earnings is 7 times. So let's find out the enterprise value this way. That is 7 times of the earnings is the enterprise value for programming services. Then what is the equation? We say 7 multiplied by 50. That is 7 times of earnings is the enterprise value. So the simple formula is 7 multiplied by 50. E5, that is EV divided by E, and then D5, that is basically earnings. So we got the enterprise value here. Let's come to the right hand side corner, and then we drag to the remaining operations 10, 110, 160, and so on. And please mind you, for head office, there'll be no earnings. So based on some similar calculation, the head office enterprise value is calculated. Now we have programming service enterprise value, coding service enterprise value, open source software enterprise value. Let's find out the head office, right? So how do you find out the head office value here? Equals to sum. Take a total of all these 4 items, C5 to C8. Then press enter. We got enterprise value here. And then we have net debt value. Let's find out the equity value. How do you fix up the equity value? We'll use this equation. So equity value is equal to the enterprise value minus debt value. C9 minus C10. So the equity value is 230. Now we have equity value and also the number of shares outstanding. So which is 20 million. So let's find out 230 million divided by 20 million. So which is reference cell C11. Divide this with C12. So the equity value per share is 11.15. So the equity value per share as per the multiple sum of business parts method is 11.5, 11.50, right? So this is how we find out the value of the company based on single business sum of parts method and multiple business sum of parts method, right? Now we have understood both the cases, single business sum of parts method and then multiple business sum of parts method, right? So let us save this file. Now, having understood this, let's go to the next case. That's basically goal-seek sensitivity and scenario analysis, right? So let's open this case now. Yeah. So first, try to understand what do you mean by goal-seek analysis. That is single constraint, multiple constraint, and then followed by sensitivity analysis and scenario analysis. So goals is it basically helps us in financial prediction, which is a particular component in the third module, financial estimation or financial projections. So how do we estimate the financial positions or the financial parameters, specific financial parameters by using the goal seek analysis, sensitivity analysis, and then scenario analysis, right? So this all these three techniques basically will help us in financial projections. We'll start with goal seek. So we have this information, unit sold, 60,703. Okay, let us fix this value now. So for the timing, let's consider 5,000. Price per unit is 5, and then cost per unit is 2.75. Office and administration overheads is 10,000. Tax rate is 21%, right? So what do we do here? The requirement is we are required to find out the net income whenever the net income 1 lakh rupees we generate, when the net income is rupees 1 lakh, right? Yeah. When the net income is rupees 1 lakh, how many units should be sold? Or to generate a net income of rupees 1 lakh, let's see how many units of this particular product should be sold. How many units of this particular product should be sold, right? Just a second. Right. Now let's try to understand, to generate a net income of rupees 1 lakh, how many units should be sold here, right? So let's use this equation. First, what we do here, we build the equation. So how do you find out the net revenue? Net revenue is simple. That is number of units sold, D5, multiplied by price per unit. Number of units sold multiplied by price per unit. D5 into D6 will give us a total revenue. Then how do you find out cost of goods sold? Cost of goods sold is equal to number of units sold, D5, multiplied by cost per unit, D7. D5 multiplied by D7. We get 13,750. Let's find out the gross profit. That's revenue, G5 minus cost of goods sold, G6, G5 minus G6. Yeah. The gross profit is cost of goods sold minus, sorry, revenue minus cost of goods sold. Let's try to find out the office and administration expenses, which is basically the fixed expenses we have in D8 reference cell. We'll put this as it is. Now, let's find out the EBT, that is before tax revenue. How do you find out before tax revenue? Gross profit minus the operating expenses. So let's presume that there's no financial cost. G7 minus G8, which is basically earnings before tax. And then the tax value we have how much? 21%. How do you fix up the tax value here? So let's use this equation. 1,250, that's a before tax, which we call it as taxable profit, multiplied by 21%, multiplied by 21%, G9 multiplied by 21%, enter. So we got the tax value. Let's find out the net income now. How do you fix up the net income? Earnings before tax, G9 minus taxes. This basically gives us the net income value. Just a second. Right. Now, we'll find out the value of net income. Value of number of units sold to estimate a net income of rupees 1 lakh, right? So how do we go about it? We'll apply the goal seek analysis to estimate the required parameter. Let's go to the data menu now. Let's go to the data menu. Go to the what if analysis. Go to the what if analysis. In what if analysis, we have something called as goal seek, right? So click on this goal seek analysis. Yeah. Let's pick up the target cell. So we'll pick up the target cell. The target cell is basically net income. So let us go to the net set cell and then select the cell G11 value. So what is the net income we are predicting here? 1 lakh, correct now? So if we want net income of rupees 1 lakh, by changing the cells, so we are trying to find out the number of units required to be sold, which is in D5 reference cell. So the input is ready. Just click OK button and then click OK. It says that, could you see here the difference? Previously, it was 5,000. To estimate a net income of rupees 1 lakh, the company is supposed to sell 60,703 rupees. Sorry, 60,703 units. To estimate a net income of rupees, to generate a net income of rupees 1 lakh, the company is supposed to pay 60,703 number of units. Number of units. Okay. This is basically a single constraint case. Let's go to the goal seek analysis, multiple constraints. We'll go to the next case, multiple constraint. Right. So let's try understanding the same case now. the same information. We'll first put the equation equals to revenue is basically number of units sold, D5 multiplied by revenue per unit, D6. Cost of goods sold is equal to number of units sold, D5 multiplied by cost per unit, D7. Let's find out the gross profit. How do you find out the gross profit? Revenue minus cost of goods sold, G5 minus G6. Office and administration expenses, basically D8, the reference cell, 10,000. Earnings before tax is equal to gross profit minus office and administration cost, G7 minus G8. Let's find out the taxes now. So taxes is equal to taxable profit multiplied by tax rate. $1,250 into 21%. Now there are two constraints here. It says that to generate a net income of rupees 1 lakh and to fix up the selling price to below 9.99. How many units the company is supposed to sell? How many units the company is supposed to sell, right? So the constraints are, let's say net income is rupees 1 lakh. The maximum number of units sold that could be 25,000. Selling price is maximum is 9.99. With this constraint, how do you predict the financial projections? Okay, what do you do here? We go to a solver add-in. In the data menu, we go to a solver add-in. If not installed, you can install the same by using Excel options. If you go to Excel options, we get the solver add-in, we can install the same. So if you click on this data menu, we have the solver add-in button here. So click on this. So let's select the target cell. The target cell is net income G11. G11. Then value equal to mention 1 lakh. So we are trying to find out the value of selling price and also number of units sold when the net income required is 1 lakh rupees. By changing the cells of 2. So we have two parameters here. So the two parameters, number of units sold and the price per unit. Basically reference cell D5 and D6. D5 to D6. We'll add the constraint now. How do you add the constraints? Click on this add button. Select the reference cell. So we say that this cell, whatever we get in D5 must be less than or is equal to 25,000. The ceiling cap is for the market demand is 25,000. Click on this add button. And the second case, price per unit should be less than or is equal to 9.99. Click on this add button. So we have added two constraints here. The value which appears in D5 should be less than or is equal to 25,000. The value which appears in price per unit must be less than or is equal to 9.99. The input is ready now. Click on this solve button. Click on the solve button. So we got the answers. It says that to generate a net income of rupees 1 lakh, the company must sell 18,865 units and the price per unit should be 9.99. Price per unit is 9.99. Right? Okay. This is what we call it as goal-seek analysis with multiple constraints. Goal-seek analysis with multiple constraints. Okay. Now let's go to the next case. Sensitivity analysis. The next case is sensitivity analysis. So we have considered the same example, the goal-seek analysis with multiple constraints. Net income is 1 lakh. The number of units sold should be 18,865. Price per unit should be 9.99. So let's generate the output now. Okay. So what is basically sensitivity analysis? It will help us in understanding how profit is sensitive with respect to the number of units sold and also the selling price per unit. Whether profit is sensitive towards the selling price and also the number of units sold, that is output. Okay, so what we do here, we'll prepare a table, sensitivity analysis table, and then based on that, we can find out how profit is sensitive to output and selling price. So the output, let's consider 18,865, the answer what we have got here. Price per unit, let it be 9.99. So shall we round up this 9.9 to 99 to 10? Yes. Right. Now we'll say that for every 5,000, we'll try to estimate what is called as the output. So how do you find out? We say 18,865 plus 5,000, 23,865, and then 28,865. Similarly, 18,865 minus 5,000. Now, in the same line, let's find out the different selling price here. So selling price will fix it as 10 plus 1, 11, and then 10 minus 1, 9. Okay. Here in the reference cell I4, sorry, L4, right, it's I4. So we'll put the net income value. Let's say is equal to 1 lakh. That is the value which is there in the G11 cell. Enter. Now the input is ready. So let's generate the sensitivity analysis value. How do you fix up this now? So we'll select these values. We'll select these values. Let's go to the data. Go to what if analysis. What if analysis. In that, select data table. So for applying sensitivity, first we must select the data. So which is basically from I4 to N9. Okay, that's a reference range. Then we go to reference cell. Sorry, we go to data menu. In that, choose what if analysis. In that, select data table. Okay. Let's feed the input now. So here, what is the row input? The row input is basically okay, selling price. So let us select selling price here, 9.99, 9.99. And then column input is basically output. Just a second. Okay. Row input is basically row input is basically units sold. Column input is basically the selling price. Click OK. Yes. So row input is basically number of units sold. Column input is price per unit, selling price per unit. So we have got selling price to output the values. Yeah. Now in this, let's find out the max value and minimum value. So we'll put the max value and also we'll try to find out the minimum value. Okay, let's see how do we find out this. Let's say equals to max, open the bracket, select the reference cell, which is basically J5 to N9, close the bracket, enter. So the maximum value is 2,02,803. Correct now? Let me highlight this cell. So what do you mean by that? When company sells 28,865 at the rate of rupees 12, the company can make a profit of 2,02,803. Let's find out the minimum value. So the equation for minimum case is equals to min, open the bracket. Select this data J5 to N9, close the bracket, enter. The minimum value is 28,797. That is when company sells 8,865 units at the rate of rupees 8. If you look at the average case, that is when company sells 18,865 at the rate of rupees 10, approximately 9.99. Could you just check out the value? The net income value is 1 lakh rupees, right? So this is how we predict the sensitivity of output and selling price towards the profit. How profit is sensitive with respect to output and selling price. So let us save this file. Yeah. So let's go to the last case, sensitivity analysis. We'll go to the last case, sensitivity analysis. So what is the sensitivity analysis? Scenario analysis. I'm sorry. What is the scenario analysis? Given different scenarios, how do you predict the financial parameters? When company, when all things goes in favor of the company, when everything is in favor of the company, what could be the financial projections? If nothing is in favor of company, how do you predict the financial projections? And so on, right? So let's understand this case. The revenue scenarios are optimistic, most likely, and pessimistic. Cost scenarios are optimistic, most likely, and then pessimistic, right? Okay. So what we'll do, we'll fix a case now. So let's say one here. Let's say one here. Come back to the revenue. We'll use this equation is equal to choose, open the bracket. Okay. Select the index number. Let's say the index number is D7. Come on. Select the value 1, value 2, value 3. First, we are talking about the revenue, right? So let's select this reference cell D10, D11, D12. That is revenue and optimistic case, revenue and a most likely case, revenue and a pessimistic case. Close the parenthesis, enter. So let us lock the cell here. Which cell should be locked now? Only the index number. So we'll drag it towards the right hand side. So we got revenue value under optimistic case. What is it? Situation one. Situation one, let's consider as optimistic. When business faces optimistic situation, how much is the revenue generated by the company? 50,000. That's the maximum value in the first case. And then 1,25,000 maximum value in the second year. And in the third year, maximum value is 2,50,000. In the same line, let's find out the cost. So the same equation is equal to choose, open the bracket, select the index number D7, come on, select the values. The values are D15, D16, D17, close the parenthesis. Before entering, we have to log the cells, right? So let us log the cells in between D and 7 and also at the beginning of D. and then enter. This is okay. So whenever we record the formula, the spelling must be correct. CHOOSE. Can you look at this now? When under optimistic situation, the minimum cost what is incurred by the company is 5,000 first year. Under the, okay, let's drag it towards the right hand side. Under the optimistic case, the minimum cost incurred by the company is 12,500 second year, 35,000, 25,000 in the third year. Correct now. So this is how we predict the maximum revenue and minimum cost under different cases: optimistic, pessimistic, and most likely. Right? Let's find out the net income case now. How do you find out the net income? We'll say revenue minus cost, 55,000. Drag it towards the right hand side, 1,37,500, 2,75,000. Okay, so we have predicted net income and optimistic case. Now, if you want for different situation, let's say if we want it for most likely, we can just change the value here. So what is most likely? Number 2, right? Just press number 2. Automatically, the revenue, cost, and net income changes. The revenue, cost, and net income appears as per the that is most likely case. If we are predicting the financial parameters for a pessimistic case, then let's put this equation, number 3. Can you see here? The revenue, cost, the minimum revenue, maximum cost, and the net income come for the pessimistic case. So now by changing the index number, we can find out what is called as the financial projections for an optimistic case, most likely case, and a pessimistic case. So this is what the sensitivity analysis refers to, right? This is what the sensitivity analysis refers to. So now we have understood the goal-seek analysis, single constraint, the goal-seek analysis, multiple constraint, and the goal-seek analysis, sensitivity analysis, and scenario analysis. Right. So now we are done with the comparable company analysis, sum of parts method, and also what is called as the goal-seek analysis, sensitivity, and scenario analysis. Right. So let us save this file.